because I'm about to whoop your
I'm not
ass.
scared. I'm not scared. Oh!
All right, hello, and welcome to Camel Finance. I'm your boy Camel, and it's Bank Holiday Monday, so not a great deal is going to be changing, but as I'm sure you're well aware, Bitcoin is changing. Bitcoin is playing catch up. So in the post where I did the deep dive TA over the weekend, I said Bitcoin was lagging. But as my boy here points out, who is lagging? Who is lagging? Because it's not Bitcoin anymore. Bitcoin is starting to do Bitcoin things once again. The big news over the weekend is that the US debt ceiling crisis is seemingly over. They made a deal for 2 more years. They're going to cut spending by $50 billion, but they're going to raise the debt ceiling by another $4 trillion. by another $4 trillion. So is this still a Ponzi? Of course it is. Has this just proven to even more people that the entire fiat system is a Ponzi? Yes, of course it has. So you better opt out, and you better buy gold, physical silver, and of course, physical Bitcoin. There's still quite a bit of confusion around the debt ceiling. You have a bunch of people saying, well, this is super bullish. Now we're going to see all the bulls and a huge blow off top develop. You also have some people telling us that actually people have misread the situation and it's going to be very bearish. So I'm going to dive into both sides of this argument right now for you. So on one side of this argument, you've got people like Ran here thinking that the market is reading this debt ceiling deal wrong. The US was never going to default, and I'll interject here to say I have to kind of agree, and I said this multiple times on the channel. Historically, they always just raise the debt ceiling, and I did say a bunch of times that I suspected this time would not be different. However, I also said that we would likely have to be open to the idea of a controlled demolition and some kind of reset to CBDCs. But, of course, we didn't get that. So, and I also said that if we were to see a controlled demolition, we'll deal with that as it turns up. But fortunately, for now at least, that didn't happen. We did, of course, do what we always have done historically, which is to raise the debt ceiling and continue to kick this can further down the road. So the US was never going to default. I don't think we could say that with certainty, but we could look back in time. We could look at history, and that would tell us, indeed, that they likely were not going to default. So arguably, there's nothing to celebrate here. Well, I think there is, because this time is quite different by many, many metrics, as I'm sure you're well aware. Like I said, we could well have been facing a controlled demolition. We certainly could well have been facing a default, some kind of massive civil unrest, some kind of massive pension theft. Who knows, right? It could have got really, really bad. And I still think at some point in the future, it possibly will. But for now, I would say there is something to celebrate, because at least we're not going full reset to CBDCs just yet at least. Also, once the debt ceiling is lifted, the Treasury will need a huge inflow of USD. This is true, and they will sell Treasuries around $1 trillion immediately. This will dry up liquidity and force the dollar stronger. Trade with caution. Now, yes, this is technically right, but remember, there's two sides to every coin, right? This isn't the only factor driving liquidity. This will have a quantitative tightening effect. This will remove liquidity from the market. But that does not mean that we have to go into net declines for liquidity. So if you think of liquidity like the ocean, you can have an undercurrent going one way, but the tide pushing the other, right? You can have the wind blowing in a third direction, and you could have the swell coming from a fourth direction. So just because we do have this factor, which is going to dry up some liquidity, remember, that doesn't necessarily mean that liquidity is going to be just removed from the market entirely and we have to crash immediately. Another channel OG here, Kamazabi, pointing out, look, so the agreement on the debt ceiling, that basically removes the ceiling for 1.5 years, voted on by a Congress that needs liquidity to exit the markets. And all of this before voting on a law to ban Congress from owning shares. It almost seems as if it's all planned out. And if I hop into this melt-up chart, this is, of course, a staple of this channel now. We have been speculating that we will see a blow-off top move that will force all of retail back into the market. All of the bears that have been on the wrong side of this market since the lows in October of last year will be forced back in higher, and providing the exit liquidity for Congress to finally be banned from owning stocks at the top, just in the same way that they banned the Fed officials from owning stocks at the prior top. So it does indeed seem a bit suspect that we have just kicked the can down the road one final time, whilst we likely enter the final blow-off top portion of this rally. And of course, as I've covered on this channel multiple times before, they are getting ready to seriously discuss banning Congress from owning stocks in the not too distant future. Is this thing going to finally come to fruition? That is, of course, to be determined. But so far, so good, and particularly when we jump into the Nasdaq, as you can see here, this is starting to look more and more like a blow off top is developing. In fact, I wonder how many percentage points we are away. A mere 17% from the all-time highs and a whopping 37% off of the lows. This is going to become very, very painful for the bears, the shorts, and those that are sidelined if this can continue. So going back to liquidity then, if we look at the Bitcoin price, which is in white here, as you can see, and we compare that to the blue, which is global M2 year over year percent change, what you can see is the liquidity, global M2, is on a sharp increase. As you can see here, Bitcoin historically has always followed and front run the advance in global liquidity. So whilst liquidity is being pulled from the market, make no mistake about it, the net effect is that liquidity is increasing as we enter what I believe will be the final blow off top portion of this melt up. We also have massive news. Of course, Hong Kong, one of the top 10 wealthiest cities, is getting into crypto in just a couple of days. Hong Kong is home to 32 billionaires. The amount of money ready to flow into this space is unfathomable. And from Hong Kong to Thailand, Binance has just got approval to operate in Thailand. Over in Colombia, people can now buy Bitcoin at over 52,000 retail outlets. Do you see the trend that is unfolding? And as if that's not enough, remember, CPI continues to come down ahead of the next readout. The lower down this number, the more likelihood that we're going to see the Fed pause. Remember, the bond market has known this for some time. Here in orange, we have the Fed funds rate, and in green, we have the 2-year yield. Historically, as denoted by each one of these blue vertical lines, every single time the Fed funds rate crossed above the 2-year yield, what we saw is the Fed move to a pause and then a cutting cycle thereafter, a pause and a cutting cycle thereafter. Is this time going to be different? I don't think so. I think this pause is just around the corner. As I've been saying over and over again, I think when we get the pause, we will get the markets front run and print the final blow off top portion of this rally before the cutting cycle and banning Congress at the top is what catalyzes the big crash that everyone has been calling for since the lows back here. The facts remain the facts. Bears are mentally ill. And we see this all the time on Twitter. 100% of my portfolio and my wife's portfolio is now triple leveraged short, triple Qs. I mean, this is how you end up broke and homeless. Do not get married to a narrative, trade what is in front of you, and what is in front of you is undeniably an uptrend consisting of higher highs and higher lows. And if you're one of these people that thinks the current triple Q rally, the current rally in the US equities is a bear market rally, just remember, this current bear market rally, if that is indeed what it is, has lasted 228 days. But the longest bear market rally in 2008 was 80 days. The longest bear market rally in the 2000s was 100 days. This does not speak to a bear market rally. This speaks to a trend reversal. And so here we have the 2023 chart, as you can see, of the Nasdaq. Does it not look eerily similar to 1983? And you can see what happened in 1983. Again, it's not a prediction. We are simply pointing at the chart and trading what is in front of us. Get a technical breakdown, and of course, we will abandon this thesis. But so far, so good. Given that it is Bank Holiday Monday, there's not a great deal going on in the markets until tomorrow. So, of course, the weekend's technical analysis deep dive and all my live positions still holds. But undeniably, what we have here is Bitcoin working on a breakout. It is working on a breakout. It is trying its best to confirm this as a daily cycle low. We had a double bottom show up, and since then, we've had an up thrust. I expect some volatility this week. I expect a lot of wicks and stuff on the Monday as we trap the people that are likely going to be FOMOing in and chasing this whole debt ceiling news. So we will be proceeding with caution into tomorrow. Ethereum showing relative strength, as you can see here, undeniably broken out. So this tells us to be open to seeing further upside from crypto. And whilst I wouldn't go chasing this current move in the Nasdaq, while some level of pullback to a touch of this yellow upward sloping support line or the red one below it would be perfectly logical and reasonable to expect, I do believe that dips are for buying, as we are currently putting in what I believe is this final portion of the rally. I also expect to see the VIX continue to pull back. So as ever, one day at a time, we'll trade only what's in front of us, no bias, no emotions. I'm your boy Camel. I hope you have a great day. I hope you enjoy the rest of your bank holiday. I hope you found value here today. And in the meantime, take care from me. All the best. Cheers. Bye.